So everyone, welcome to today's webinar on how to find a national Whole Foods launch or any other retailer, whether that's Target or Sprouts. We all know that growing within any national retail account takes a lot of money. There's a couple ways of doing that for the equity approach, and then from the debt approach, and kind of the pros and cons of each one. So we want to make sure that you are making the best decision for your business that's going to bring both short-term and long-term success. So for this conversation, I have invited on Tej, and Tej is working within the space right now, actively working with dozens, almost up to hundreds of companies to get funding to grow their brands in retail and to help cover those costs. And so what we want to do today is really paint that picture, like what it looks like. We're going to be focusing a little bit on the financing side, so getting either PO or invoice financing for your brand, what that looks like, what it entails, the when not to do it, and probably when to do it, so that you can make the best decision for your business. So as always, if you have questions throughout, definitely let me know in the chat. We'll get those answered, and then we'll have time for the Q&A at the end. Awesome. So Tej, I'd like to welcome you up. Tej is the CEO of SpringCash. As I mentioned, he's working actively with a lot of brands. Tej, why don't I'd love to hear from you what it's looking like right now, just in terms of brands launching with retailers. I see a lot of activity, a lot of momentum behind brands right now, and are you seeing the same?
Great. So since I can kick things off, tell you a little about, my background, what we do here at SpringCash. Would love to intro Will. He's our chief credit officer, my co-founder. He's the one who actually approves or declines, all of our investments. But also prior to this, he was the first underwriter at Wayflyer in the US, where he kind of underwrote billions of dollars of deals. And so, he can also chime in. So, Will, do you want to give your background? Then I can kind of kick things off on my side. Also, I think you might be muted.
There we go. In addition to that, and what I think is relevant to this combo is, while I was at Waveflyer, originally when I joined Waveflyer, they only provided e-commerce finance. And then while we were there, we kept having brands asking us like, oh, I sell on the Target, I sell on the Whole Foods, I'm omni-channel, can you provide funding for that? And eventually that question got asked enough times that we were like, we should probably figure out if we should fund this. And then I was on part of the team that built out the wholesale retail finance program at Wayflyers. And the issue was the way they built it out was they tried to shove like an MCA type repayment structure into that payments. And so they started giving credit for that revenue, but never actually funding against it. And Jordan, I guess going to your question there, like what we're seeing in the space now, when we did this program at Wayflyer and built it out, it was really common that the brands that we're meeting with were selling regionally for their launch. It's like, oh, I'm launching Target Southeast. I'm launching Kroger, I don't know, Maryland. Now the conversation that I hear every day is, hey, I'm going Target nationwide. I'm going Costco nationwide. And this puts huge pressures on the business, no matter what size you are. We've done 3 PO finance deals recently, which I think kind of really highlight the scale and size of the problem and the opportunities there for you to grow, but also the missteps. Like one is a protein bar company that got a multi-million-dollar, they're not 8-figure in revenue, but got a multi-million-dollar order from Costco, which put a lot of pressure on them that we helped step in and fund. Another is a fast emerging beverage brand based out of Australia. They're doing, had just crossed call it the 7-figure mark, $1.5 million in revenue, and their Walmart POs for their first 2 months launching there was over $1 million. So nearly basically a year's worth of revenue in one order from Walmart. And that's a major change from what I was seeing in 2022, where it was regional and bite-sized, and you could kind of like maybe self-fund, just get a little extra capital, versus now these retailers are asking for huge commitments, which obviously puts a capital constraint on the business and some operational pieces as well, where it's like if you have limited inventory, how are you going to allocate that between your D2C sales, your other retailers, and these new doors that you're launching in?
Yep. So this is some of the stuff Will's done here at SpringCash. I can kick things off on my side by talking about my background and how I kind of got into the space, what we do here at Spring. But I really want to focus, I think, just to tell you a little about what PO financing is, what invoice factoring is, and what you should look for. As my recommendation with all these is to chat with 10 people and a lot of it is just even knowing what questions to ask. So that's kind of the majority of the presentation. My background is before co-founder and CEO of SpringCash, we just raised $336 million to offer PO financing and invoice factoring for CPG brands that sell into retail and wholesale. Before this, I was on the equity side. So I was an investor at Coatue, which is a hedge fund. It was me and about 30 other investors. Collectively, we managed about $65 billion. I was on the venture capital team where we were on the board of TikTok and early investors in companies like DoorDash, Instacart, Uber, Snapchat, Spotify, and about 200 others. And then the reason we started this business is because my other co-founder, Samir, so he's providing most of the financing because he owns a bank that provides our debt facility. Samir's background is actually pretty interesting. He has a lot more background in debt as opposed to me, which is mostly in equity. So Samir, he started a company 25 years ago called India Bulls. It became India's third largest mortgage company, gave out $35 billion in mortgages to 500,000 people, generated $1.8 billion in dividends that he gave back to equity holders. Ended up, was a publicly traded company, peak market cap about $10 billion, sold the business, moved to London, and then he bought a bank called GB Bank. And so the bank grew in the last year from about 300 million in customer deposits to about $3 billion in customer deposits. And that's, obviously banks only make money when they lend that money out to other businesses as opposed to it just sitting at the bank. And that's kind of why we started this business. So let me just share my screen. So that's kind of what we do at SpringCash. Here's some, Samir's background and my background and Will's background. What I think I can kick things off. What is invoice factoring? So invoice factoring is, let's say you sell soda and Target wants $100,000 of soda. So they give you a purchase order for $100,000. What ends up happening is, let's say you already paid your factory, or I'm talking about the case at the very end. We'll talk about PO financing after, but invoice factoring is, let's say you've already paid your factory to produce these, $100,000 worth of soda. You've already delivered it to Target. You've, either you have like whatever, it's at their distribution center, and you send Target an invoice for $100,000. Target typically will pay back, let's say, in 45 days. What most invoice factoring companies will do is say, hey, instead of you getting $100,000 back from Target in 45 days, we'll give you $98,000 to $99,000 cash today, and we get paid back by Target in 30 to 40, and let's just say it's 30 days to make the terms easy, to pay back in 30 days. What my recommendation is, for what we've typically seen, the easiest way for small brands to get, initial financing is often we'll see them take out SBA loans. An SBA loan is backed by your, local bank. And the interesting thing we've seen about that is that it's typically what we've seen the easiest, as long as there's some sort of financials, it's relatively easier to get a SBA loan for a multi-year long period. Why? Because the government backs them. So if you go to your bank and get $1 million loan and you're not able to pay it back, the government will actually pay the bank a lot of the funding of the loan, and that's why that's why banks are more willing to kind of give those type of financing for small businesses. After we've seen a lot of people do SBA loans. That's kind of what we initially see. Then once you tap that out, my recommendation is, if you're in retail, do invoice factoring first among the people that you already have accounts receivable with. Why? Because whoever in lending gives you money, they price the interest rate commensurate with the risk they have. And so let's say a company comes along and says, hey, I'll give you 50 grand now, pay me back 50 grand in a month. Your business could not do well in a month. You could, if your all business is running mainly on, Meta and Google ads, and suddenly CAC starts increasing, etc. The thing about invoice factoring is that it has the lowest rates in the industry. Why? Because they check that, for example, you've delivered this $100,000 of soda to Target, because they have to have a proof of delivery. So whether it's a bill of lading or, Target, usually for the large retailers like Target, they have a portal called Partners Online, or if you're Walmart, it's called Supplier One or Retail Link, or KeHE has a thing called. By the way, in general, for Whole Foods, almost no one actually sells directly to Whole Foods. They have the specific policy. You sell to a distributor, and the distributor then sells it to Whole Foods, primarily because Whole Foods doesn't want hundreds of different trucks showing up at the Whole Foods. It's just easier to use. So most people, FYI, if you ever enter Whole Foods, you go through a distributor. It's typically KeHE is one, KEHE, and Unify is the other large one, UNFI. And so the way it works is, invoice factoring companies will say, okay, you've delivered this 100,000 of soda to Target. Show me that you've already delivered the soda. So you'll show them a proof of delivery, which is like a bill of lading. Your trucking company showing that it was sent to, arrived at Target's distribution center, for example. And then they'll also ask for the purchase order to say, hey, did Target even want this $100,000 of soda in the first place, right? You can't just send soda to Target. And then once you have the invoice, the purchase order, and the proof of delivery, they'll give you, let's say, $99,000 in cash. The reason they get paid back directly from Target is because the rates are so low that on a $100,000 transaction, they're only charging $1,000. If, for example, Target pays the brand back the 100,000 and the brand's unable to pay the lending company back because, for example, we've seen this, they have inventory stuck at a port and they need to pay the factory and they want to release it, and like there's all these like last minute things that come up. And so if, for example, the amount is not able to pay back by the lender and the lender loses the 100,000, they only made 1,000 of revenue, so they have to do another 100 deals in a row just to come back to break even, right? And so typically on a $100,000 transaction, your actual profit, lender's making 1,000 of revenue, the actual profit's only about $500. So if they ever lose the 100,000, they have to do 200 deals in a row with zero losses just to get back to normal. But that's why, for example, the rates can be ultra low because they're getting paid directly by Target. The risk with invoice factoring, for example, is that Target goes bankrupt and Target doesn't pay, right? By getting paid directly by Target, Walmart, Unifi, Whole Foods, invoice factoring companies are able to offer you the lowest rates. So that's the recommendation, which is if you need $300,000, if you already have, for example, and all these numbers obviously get scaled down, instead of 300, it'll be 30,000 because I know these are emerging brands. But let's say you need $300,000. If you have $100,000 of product that you've sent out to different retailers, like 30 to Target, 20 to Whole Foods, 10 to Wegmans, and 40 to Publix, factor all of that because it's the least risky for lenders, and therefore you'll get the lowest rate. So that's kind of what invoice factoring is. After that is PO financing. So let's say you need the extra 200,000 after you've gotten 100,000 from invoice factoring. What PO financing is typically. So let's say you're entering. One of the latest deals we did was a pistachio company, and they had a $2 million purchase order from Costco. A pistachio cream company. Out of nowhere, suddenly, by the way, in general, everyone, Costco's are, what we've seen is like it's the one retailer that like gives huge POs really quickly, and they're pretty meaningful, right? And so it's really rare to see this in a bunch of other things, and they're all usually phased out. Costco will be pretty kind of compressed, et cetera. So let's say you get a $2 million PO from Costco, which means that if you have to deliver, let's continue the soda example. If you need to deliver $2 million of soda to Costco, typically it'll take you about $1 million to produce that item, right? Your co-packer or co-man will need about $1 million. What PO financing companies will do is that once Costco has shown you that purchase order and it's verified, they will then pay your co-packer or co-man directly the $1 million. And that way, they also, by paying the co-packer or co-man directly, they reduce the risk that they give $1 million to you, and then you go to Vegas with it, for example, right? And so they know that, for example, very few people are going to defraud a lending company by taking $1 million and sending to a random dairy farmer or a packaging company or et cetera, right? And so that's PO financing, which you get a purchase order from a retailer, typically up to 50% cost, is they pay whatever your costs are to produce it. And so this is kind of what I typically recommend looking for. Obviously this is a higher level detail, and the very nuances is like extremely, nuanced for every, brand, but and financing partner. Let me talk about what you should think about and ask for when evaluating a potential invoice factoring or PO financing company.
Tej, real quick, one thing that I want to do as well is just do a quick poll to see who has used invoice or PO financing. And so I just put up a quick poll if you wouldn't mind filling that out. If you've done PO financing, invoice financing, revenue-based financing, or none, you can just leave blank, just to get a sense of what people have and haven't done. And so it looks like most people have not used either. One person has done PO financing, one's doing the revenue-based financing. That's when, a lot of times do Shopify or companies like that who offer it. So I think a lot of people, sounds like, are new to this. Okay.
Great. So the first thing I would ask is the turnaround time for how long it takes to diligence. So some of the people that we've moved over, they work with a company like Express Trade Capital or other eCapital and other lenders, where the diligence process typically takes up to 2 months. So the first thing is like I don't think many founders realize that they're so used to, in an economy of Wayflyers and Clearco's and Shopify Capitals where you get funding within 2 days. I would like ask them what's the median time and to get funded. And so like that is probably the biggest delta and shock value And people have. And so nowadays, a lot of companies are actually using AI to analyze your purchase order, invoice, proof of delivery, look at your bank statements. And that's why, for example, most of our deals, we do, same day, almost all. So that's kind of the first thing to look for. Second thing is the personal guarantee. And so a traditional lending company will require for an early stage brand, a personal guarantee, which means that if they give you if you have $100,000 PO from Target for soda and you need $50,000 to pay your co-packer or co-man, if the company's unable to get the $50,000 back because, for example, soda goes bad, like the cans pop because of carbonation, whatever, that you personally have to, the company will have to pay, but if the company runs out of money, you personally, out of your own personal checking account and Chase or whatever, will have to pay the $50,000 back. That is a traditional personal guarantee. I would look for typically what we do and what more modern day lenders do is it's called a validity agreement, which means that a personal guarantee only exists if, for example, you commit fraud. For example, you submit a fake invoice, like instead you generate it in Photoshop, a fake Costco PO or invoice, etc. So that's the first thing, which is like there are lenders that don't require personal guarantees. That's the first thing to ask. The next thing is spend restrictions. And so sometimes lenders will say, hey, this money can only be spent on, for example, like on PO financing, only this particular type of dairy farm, or you can't use it on trucking or the higher risk activity. So like generally, this more so comes into ABLs, like asset-based lenders, where they give you funding and they say what you can spend it on and what you can't spend it on, even though it's technically, you're lending your money, but because they're lending it out to you, they want to put restriction on it. So I would ask about spend restrictions. The third thing is that hidden cost. And so one example of this is this, which is on a $100,000 invoice. If you give Target a $100,000 invoice after you delivered 100,000 of soda, most invoice factoring companies will only give you $80,000 of that, advance 80,000 of that. Why? Because inevitably, no one really gets the entire $100,000 back. There's chargebacks, deductions, slotting fees, free fills, etc. For example, if you're at Target and your product is at the very end of the aisle, it's called an end cap, and that usually is like literally will be like $40,000, $50,000, for a particular period. Like these aren't small amounts. Or so, for example, if your item is typically if your item sells for $4 and it's on sale and it's at $3, that $1 difference, anytime you go to a Target or whatever, that $1 is typically paid by the brand. Like Target's not actually discounting, the brand is paying for it. So anytime, so for example, the reason why this is pretty crazy is if you sell soda for $4, you're only making $2 off of it, and Target's selling the other $2. You're selling the soda to $2 at Target, and then they mark it up for $4. If Target and you work together to give a $1 discount from $4 to $3, it's coming out of your pocket. You're only making $2 out of the $4 to begin with. Now the $1, by the way, the discount is all from your side, so now you're only making $1. So your entire revenue of Target, will be half. And so that's why, most invoice factoring companies, this is another thing you should ask about the advance rate. Instead of 100%, they'll give you 80% because they know that out of $100,000 invoice, if Target only pays 86,000, then they'll give the 6 extra back to you. They don't need to claw back 14 from your bank account. Now, here's the thing, for example, let's say someone charges 1%. It's different if someone says, hey, I'm going to charge you 1% on this $100,000 invoice, but only give you 80,000, because on that, effectively your rate on that 80,000, you're paying 1% on $80,000, right? It's a $100,000 transaction or invoice, but you're only getting 80,000 in cash. So your effective rate, by the way, is 1.2, 1.3, whatever, right? And so if two companies both offer 1%, if they state that, hey, our rates are 1% a month, look at the advance rate. Is that rate 1% on 80 grand or 80, et cetera? The next one is no all asset liens. So typically, like Wayflyers and of the world, what they'll do is an all asset lien, which means that if they give you $100,000 and you don't pay it back, then they can go after your inventory, equipment. Technically it's called intangibles, which means that if it's your branding and website, which means that if you don't pay them back, they can theoretically use your website and sell your product at a fire sale to get paid back. And so what we typically do, for example, is our liens are only just on those specific invoices and accounts receivable or factoring, not on equipment or inventory, et cetera. So that's just in general something to think about and ask about as you speak to a bunch of different people, which is like, give me the exact language of the UCC lien that you're filing. And then in this case, yeah, just like ask for the total all. So, our best practice, what we do is we say, hey, this is the fee we're charging. It's inclusive of everything. It's not, there's no unused line. Like, for example, most invoice factoring companies, when you sign up with them, they'll say, hey, there's $1 million. You have to spend $1 million with us throughout the year. Because if they're making 1% on something and you factor $1 million of invoices through them, they're only making 10,000 of actual revenue, right? And they have costs and people and labor and to process all these invoices. And so that's why they really do require a minimum amount to fund through them throughout the year. And so I would ask about all the, or cancellation fees is something we typically see. One of our clients was eCapital had to pay $20,000 to leave the contract to switch to us. And so that's kind of like on this particular is a tangible example to think about. And then on here, I would ask for the exact specific lien language and say, is your lien on just the accounts receivable or your in is an all asset lien? Grace period. This is an example of, let's say someone gives you $100,000 for an invoice for this Target invoice, and on day 30, Target's supposed to pay the $100,000 back. If by day 35, for example, what most invoice factoring companies do, on day 31, if Target does not pay it back, then they'll ask you for the money because they need to get paid from either one way, whether it's Target or you, et cetera. And so what we do in some other modern lenders is called a grace period, which is like, hey, we'll wait 5 days or 10 days, whatever, up until if it's a 30-day invoice, it's actually due on day 35. Because sometimes, for example, these distributors and even large ones will send stuff via check in the mail. And the reason, by the way, they send via check is actually intentional, because if on the 30th, if they wire 100,000 to you, the money leaves their bank account. Versus if they issue a check on the 30th, it'll take 3-4 days to arrive. And then typically founders are not going to deposit it the same day. They'll wait 2-3 days. And so they get an extra 5-6 days before the money actually leaves their bank account. And so, but like this grace period especially is important, especially if, if the invoice factoring company is getting checks and they actually might not actually arrive on day 30. Flexible payments on repayments on default. This is another pretty interesting thing. What this, so most, like I said, typical, some lenders, the way it'll work is if they give you 100,000 for this Target invoice, and by day 30, if Target does not pay, then on day 31, they'll just pull all 100,000 from your bank account. Obviously, this has issues because if you give a founder 99,000 in the first place and they have to repay back 100 in 30 days, when they give you 99,000, most founders actually, the 100,000, the 99 for sure is not there at the end of the month, because if they had the capital to do that, then why would they even be using invoice factoring in the first place? But more so, all that money is being plowed into inventory and purchase orders, right? So it's not just sitting in the bank account. And so on day 31, if Target, for example, does not pay the 100,000 or is delayed, if they pull 100,000 from your bank, it's insane, in my opinion. And so what some lenders, including us, the model we have innovated on is that the first of all, there's a 5-day grace period. So if we give someone 99,000, on day 30, if we're not getting paid, then we wait until day 35. If we still have not gotten paid, then on day 36, instead of pulling all 100,000 immediately, we split up into chunks. And that's something you should ask about, on how repayment works. If, so in our case, if a brand is about $1 million in revenue, we pull 1,600 per day until it's paid back. So even though theoretically most people will pull 100,000 on day 31, for us, in day 36, we do 1,600, day 37, 1,600, day 38, 1,600, day 39, 1,600. Let's say, if 10 days later, Target does pay, you've already paid 16,000, that money gets sent back to you if we've gotten paid in full by Target, et cetera. So that's kind of what, I would really hone in on how repayments work if the retailer or distributor pays late. The next thing is typically most companies will classify this as a loan. And where they're giving you money and you want money back. Obviously, this shows up on your balance sheet as a loan, which is part of the debt, the debt category. What I would, ask if I were you, and is how is it, what's the actual legal structure? So for example, what we do, it's called a purchase of receivables. So it actually doesn't show up as debt on the balance sheet. It's not actually a loan. And so some of the terminology, I use, words that, are used for loans to make it easy to understand, but under the hood, it's actually purchase receivables. What this means is that technically, when you work with us or any other invoice factoring company, if they structure it properly, if you have a $100,000 invoice you sent to Target, when they give you $99,000, well, effectively what they're doing is they're buying that piece of paper, that invoice. It's not paper, obviously, we know it's through EDI, SPS, but that piece of paper invoice, they're buying that from you for $99,000 in cash. Now, once that invoice factoring company has that piece of paper, it entitles them to get paid the $100,000 from Target. And so effectively buying that invoice, that piece of paper for $99,000, that piece of paper then allows them, is the right to get the $100,000. So the way this works is we're purchasing it. You're basically selling your invoices, which counts as revenue, as opposed to having debt. So that's another thing I would think about. A lot of times you see invoice factoring companies structured as just typically debt. which then shows up in your balance sheet and makes it harder in the future when you have other lenders, because it, obviously if you want to get additional funding in the future from someone else, it's better to not have debt listed on your balance sheet as opposed to just, yeah. And then the minimum is what I talked about. A lot of factoring companies will require, $1 million or $2 million or X dollars to, use them. And if they don't, then they must charge you the fees of invoices you have to run through them. Yeah, that's kind of it. That's a little bit about what we look for. I mean, these are some of the brands we work with, Supermotion, we factor the target invoices, reach out to, some of these brands, the founders, and they can kind of tell you more about, what their experience with invoice factoring has been like. So, we factor targets, Supermotion's target invoices. Laurel's Coffee is actually probably the best example to mention here. She launched about a little, like, I don't know, 13 months ago. So 13 months ago, she launched. She went nationwide in Whole Foods like 3 months ago. So 10 months, less than a year after launching, she had a full nationwide rollout of Whole Foods. So for example, we factor all our invoices with our various distributors like Rainforest and High Touch and Dairy Delivery and Unify, et cetera. But she's, Isabel's a great kind of reference case study to even just see her experience and how she funded her, growth. Cloud 23 is Brooklyn Beckham's hot sauce brand. So, he's been, they're, really, savvy when it comes to on financing, and I really look up to them as partners. And so, that's an example of someone else. And then Plug is, they make this anti-hangover drink that also has kind of some experience. And then Original Crumbs is, they sell this 5-pound cupcake at Kroger. It's the #1 new selling item at Kroger Bakery. And we factored, their Dot Foods invoice. The Dot Foods is actually a distributor. So we actually do their business outside of Kroger. We do all of their 7-Eleven and some of the other, stores. And so, yeah, that's a little bit about, us and invoice factoring, and hopefully it was helpful, and just kind of a lot of, times when it comes down to just about knowing what the right questions to ask. And that way, even, so a lot of times the worst things is there's unknown unknowns. And so, yeah, hopefully
Yeah,
that's
this is awesome. If anyone has questions about these or PO financing, invoice financing, definitely let us know in the chat. Happy to answer that. Tej, coming from the equity side, when should a brand use equity to fund growth, and for what, versus using tools like invoice and PO financing?
Yeah, so I would say I there are like technical answers, and then there's also like peace of mind answers, right? Which is like technically, right, what you should do is you should raise as little equity as possible. And also, by the way, I mean, I'm also, the best companies in my opinion are like RX Bar, right? Like raise very little money, grow sell for hundreds of millions of dollars, or like, and like you own 100, but not having investors is great because you don't like technically have to like report to outside people. There's less pressure of like growth, et cetera. So like I would, in theory, if you could fund it yourself, I would never take equity dollars. And that's coming from like a venture capitalist, right? Former VC. That being said, there's just practical considerations. And sometimes it comes down to, for example, if you're making a protein, bar company, like sure, David, you're going up against David, and they've, bought end caps everywhere, and they're, giving heavy discounts to, their local distributors, such that they're in all the bodegas in New York. And they're also, every time you sponsor, you see someone's name on a truck, like typically those are like, 2-year agreements, but that's like $4,000 each truck. And so like, a lot of times, I think it's less so in CPG, but in venture capital, it's kind of like a winner takes all, right? Which is like, there's only one notion or one, ramp, or one, like the #1 market share, is captures most of the profits. So that being said, my recommendation is I would, in general, for peace of mind, I've worked with a lot of companies, and obviously it's better to own a lot of your piece of, of your company, but it just is, it's a lot less of a headache and peace of mind to just have equity dollars at stake. But then the #1 easiest thing we've seen is just like control your burn by being really careful with funding. And this happens with every first-time founder, which is like, hey, let me spend, this discount or that discount. And so typically until you have product market fit, it gets really hard to, especially because CPG is fairly a little bit more commoditized of an industry, right? As opposed to tech, where it's, and I have zero experience in CPG investing. And so I'm kind of using a little bit of my, of tech investing background. But what I'd recommend, take some initial equity dollars, and then often once you're in retailers, you have invoices, then do invoice financing, and then PO financing after that.
Well, Jordan, from my seat, so I'm actually an active CPG angel investor and part of a number of groups. Investors don't want to be diluted. And so if you're able to find, much like the owner, so your interests get very aligned once you become an investor in it. And so, when you see a brand and they're like, hey, they have these growth opportunities, and option one is raise 500K of equity to go fund this Whole Foods order. Like, it's great that you're going to go in, but now you've just created a lot of dilution because you're probably being valued in $5-6 million, right? You're gonna have 10% of the company to fund this Whole Foods order. If you're able to finance that, the solution like us doing the purchase order finance or getting factoring, like that, right? That debt is non-dilutive, and even rates that could seem high. I've worked with founders and actually invested in this particular company. He was paying upwards of 45, 50% APR on MCAs, which seemed outrageous. They were at that point doing $30 million in revenue over the prior year, but growing like a weed. However, you don't meet many $30 million revenue companies in this space where the owners still have 94% of the business. And so he knew that that debt was really expensive. He was an ex private equity banker or private equity guy, previous investment banker. But he's like, I'd rather pay 40 plus something percent to this MCA provider and keep all my equity because now I own 2% of his business rather than having giving up equity earlier down the road. And so even a very expensive debt option is a lot cheaper than equity because anyone who's investing in an early stage CPG business, they're not investing to make a 2x return over 5 years, which is like a 15% or even a 3x, like 30%, 40%. They're looking to get 200%, right? They're going for those big exits. And so that means their capital is really expensive because that's the return that they're looking for. So anytime that you can use debt to replace equity, it's better as long as it's putting you in you're not over leveraging yourself. And that's why it's better to work with a solution like us, where it's like matching the cash flow versus those MCAs, where sometimes when you start to stack, and now all of a sudden every dollar you're bringing in, you have to give 50% away to someone else.
But yeah, but if I
Yeah,
wasn't
one
clear
thing I
enough,
always
if you
like to
have
think
an
about too
active,
is using debt for like a short-term return, right? Yeah,
yeah, if I
like
Yeah,
wasn't
that,
clear, if you have an active PO or an invoice, it would first of all, if you actually have invoices with retailers, that's the most obvious thing ever to use invoice factoring because the rates are low and like also the odd that you get defaulted and it is super low because like there are invoices they're going to pay, right? And so like that is like the most number one obvious. And maybe I'm so in this industry day to day, you kind of forget about whatever. But the minute you have actual invoices from any retailer or distributor or et cetera, like use invoice factoring. And then when you actually have any additional dollar amounts you need, then use PO financing. And then once you've done those two things, I would then be careful about, taking on equity or like a traditional large debt line from a bank, because for example, if you can't pay it, then you lose the company. And then also the minute you're extremely in debt, it also becomes harder to raise, VC funding. And so, but like the first thing is do invoice factoring, then PO financing, and then kind of think through your options, whether it's Wayflyer or a bank, loan through an SBA or, equity funding. And obviously the least, inclination is to do equity funding, but like I would not automatically, sometimes the pendulum shifts too far. It's like never go over your company. And it's like, but you also be careful about debt because like, you can lose, it's worse, to have, no company as opposed to, 30%, 15% less of a company that's still alive.
I mean, with that touch, like, how do you make sure as a brand that you are not over leveraging yourself and that you are planning your debt accordingly so that after everything, you're still coming out ahead and don't feel like you're in this debt spiral?
Yeah, you just look at the repayments, right? So for example, with Target and some of these others or retail, they're unified. They tell you you'll get paid this amount on this day, et cetera. And then look at the debt payments that you have to make, right? Whether it's a balloon payment after 2 years or 3 years, or it's a monthly payment or bi-weekly or a Wayflyer does it that comes out of your Shopify store that like really match the payments you have to make with the payments that are coming in through your various retailer distributors.
Awesome. Love that. Any other questions that people have? And Dill had a question. And Dill, do you want to come up and ask your question?
Hi, sorry, can you hear me?
Yes.
Hi. Yeah, so I was just wondering, just because I have been working on a agave cocktail brand. So I was wondering how early should someone like me how early should you be starting to prepare like financially before you even start approaching sort of national retailers? That's what I'd like to know.
Oh, Will, do you want to take this?
Yeah, I mean, what I've seen the most success, and Tej and I are meeting with these brands every day, is like they often get in a few local stores, like as they're testing it out, and then they get, you know, are in with a few small retailers, and then at that 6 month, 9 month mark, they're getting that nationwide launch. And the stories though, they definitely vary, and because sometimes I've been trying to understand a bit better myself what the buyer's mind on like pushing nationwide versus, like I said, when I started being more regional. And a lot of times there's definitely some serendipity involved in being at the right place, and that comes down to going to conferences and having people introduce you to buyers, and then being in their sphere that they try it and they're like they see a hole in the market, and so it doesn't hurt to like get feelers out there because if you speak to a bunch of different national retailers, right, like the one that maybe would have taken you on is like the last one on the list. It's sort of like meeting investors. So you gotta like put the time in. And honestly, it has been a mix. Like I've seen a couple brands get commitments nationwide off of like one company was pre-revenue, which is definitely an unusual case, based on the uniqueness of their product. But it doesn't hurt to get yourself out there. But I think the best case is like, showing you have like some local traction and then get into some like a local chain, and then you can push on the national side.
And I think
What we've
go ahead.
typically seen is, so Fair, FAIRE is a platform where you can sell it directly to a bunch of, so Fair, Mabel and Airgoods, MABLE and Airgoods, AIRGOODS is what we see a lot on, because we see, bank transactions is local stores, independent mom and pops buying your product. So that's also probably an easy way to show, traction and repeat purchases from, so that's kind of, you don't really need a national buyer at Whole Foods to come to you. Because you can obviously sell through some of these retailers and build up some revenue that way and show repeat purchase data. And then second is like I actually coming to this industry new. It's like it's pretty crazy how a broker driven it is, right? And so a lot of these introductions to these retailers through like it's really true a broker, right? And finding the right broker. And so we have a bunch of customers. I can kind of, if we want to email me, I can get you exact names. My email is Tej, TEJ at springcash.com. To even, figure out from existing customers, what are the brokers they use. But, Isabella used a broker and some of these others, and it really truly helps with that. Like, for example, Target, and often these brokers, they're actually former buyers so when I say buyer at Target, we're talking about at corporate, the term they use buyers, right? The person placing, the $1 million POs. Like if you work at Target and you're a buyer, then when you retire, you become a broker where you find emerging brands and you call up your friend who's still a buyer at Target, right? And so that's kind of, that's often pretty big at Target, at Costco as well, and a bunch of these others. So like second is like find a really interesting broker. And then third is obviously there's a bunch of these opportunities. I think like Walmart has this like annual thing. I think it was called the Golden Ticket is what you get, and a bunch of these other retailers have. Like for example, the latest one, and one third to last invoice factoring deal, PO financing deal was with a brand that, it's a hot sauce brand. They now in the Sprouts innovation set. And so Sprouts actually has like pretty favorable terms where they'll actually typically, sometimes what happens if you go to a store, it's called consignment, which is like, hey, they'll buy $50,000 of your items. If only 20,000 sell, then you have to pay back the other 30,000. It just won't pay you for that 20,000 that you already have sold. Sprouts innovation set, they actually buy the entire, to my knowledge, they buy the entire set up front. And so even if it doesn't sell, they're on the hook for it. And it's like, it's a six-figure purchase order. So that's kind of, so Sprouts has that, Walmart, has their annual thing. And those are kind of the three things I'd recommend, if you're starting out. So like look at some of these, opportunities like Sprouts and Walmart, the programs they have, find a really interesting broker, and then also try bootstrapping initially through Fair, FAIRE, as kind of to sell into local stores to get some of that purchase data, which is great for venture capitalists because they obviously look at unit economics and all these other things, but also get some traction but yeah.
The other thing I'll mention just financially as you're launching into a new retailer is making sure that you've proven out your value proposition and your velocities at a smaller scale, because national launches are incredibly expensive. If you think there's 20 to 50,000 items on the grocery shelf, how is someone going to discover your product? And you'll need a lot of marketing spend. So a lot of brands I talk to will spend $1 to $5 million through marketing, merchandising, promotions over the course of a year or two after a launch. And you need to make sure you have the cash to support that so your product doesn't disappear, stay on the shelf and sit, and then you get discontinued after all of that work to do it. So always make sure that you plan enough cash on hand so that you can support all the marketing and merchandising activities for that. Kind of coupled with that, Jenna had a question. How much would you recommend someone borrows to launch nationally with Whole Foods? Like what percentage of revenue or maybe the invoice?
Yeah, on the percentage on what you should borrow, like what we do and most other providers in the space is they're funding the inventory cost, right? So if it's $100,000 PO and it costs you $40,000 for the goods, like that's what you should borrow for the purchase order finance. And then once it becomes an invoice, you could factor it and kind of get, right, your profit back that way. But it should really be focusing on financing, just the cost you need. And then as Jordan said, right, launches are incredibly complex. It's important as you're thinking about kind of everything in the business. And I'm certainly not an expert on this part, but like a bunch of little things can add up where like your packaging, right, needs to be like the right size, even like sizing even of it. Like was speaking to somebody who had to order a whole new tens of thousands of dollars worth of boxes because like the requirement for the shelving and it's a freezer product was like the shelves were like 1 inch shorter than like what his packaging was, and so they couldn't accept it until he made new packaging. And so as you're approaching like even right that part of the design, keep in mind like, okay, if I'm gonna go right, if I want to kind of go into this space, what other little pieces do I need to know to make sure I don't actually have to go spend all this money again and throw away money on packaging? And that's, I think, where, like, as Tej mentioned, the broker and Jordan, the brokers could be really useful because, they've been there, done that, and they could stop you from throwing money into something that you then have to repeat or just get saved for other retailers. And so, a little bit of research can go a long way in saving you money on costs that you weren't expecting.
Yeah, the other things I'll add too, right, is if you are selling through a distributor, knowing that those first POs usually have a higher percentage of deductions and chargebacks on them. And so if you are financing, let's just say 90% of an invoice, but that distributor might only pay 70% of the invoice after all the chargebacks and deductions and fees, that you're accounting for that. So you're not going and spending all the money to realize you're actually getting paid back less than that. And I guess, Tej and Will, how do you handle that, right? If you get an invoice from a distributor, but knowing after all the chargebacks and fees that you're not going to get the full amount, how do you take that into account of like how much you finance?
Yeah, on that point, actually, what you brought up is like really, really interesting. I totally forgot, because some of these things, by the way, are so common, so used to it, you forget that they're for first time founders in retail. But like literally, if you get a $50,000 purchase order from, let's say, so the way there's a really popular distributor in New York that basically supplies most of the grocery, like small, like bodegas, chains, whatever, and they charge about about 15% of the PO value. So no matter what, if you get a $100,000 PO from them, even if you do everything perfectly, you only get $85,000 back. So that's the first thing. The other thing is that when you first enter a retailer distributor, there's things called slotting fees. So you have to pay money to just be on the shelf because obviously like the margins on the grocery stores are really thin, like 3, 4, 5, 6%. And so they really cannot afford to like have people like so they have to pay slotting fees. And then there's a thing called free fills, which is anytime if you sell, let's say, pancakes at Whole Foods, the first set of boxes to fill like that shelf, typically you have to provide for free. And obviously these are just like generalized numbers and the actual number is very specific, just to give kind of the broad perspective. So like that first amount of set of inventory in a lot of the stores, there are X number, it's called cases per store, it's free fills. You don't even get paid. You have to actually quote unquote donate it, right, effectively. And so it is very common, I would say, on a $50,000 purchase order to actually make $0 on that, to get $0 in cash back. And so typically this just comes down to looking at the exact same, the exact, and the other thing, by the way, is sometimes it's on consignment. So, actually, here's another thing. So this popular distributor in New York, the way they do it is, even though it's a 30-day net invoice, so they want 50,000 of soda. Let's say you've given the 50,000 of soda to the distributor. They're the ones who actually give it to Whole Foods. That's such how Whole Foods works. The distributor, even though it's a 30-day invoice, they say we will not pay you this invoice until we issue the second PO. Like the typical that 30 and 45 actually often do not apply for the very first time you sell a SKU in a retailer or whatever. Like it's it's like an exception, which is crazy. So like that's the first thing. Like so that's something we look at, which is also something for you to even like read specifically in this contract. Another thing we've seen in this, in sometimes with distributors is like they will say there's like minimum like marketing budgets you have to spend. So like, hey, you'll give us 15% off on this many products 4 times a year. And they say the distributors, okay, this is our marketing expense because hey, like we do marketing for you at Whole Foods, like end caps, and you. Long story short, there's like these deductions that are in this pretty contract, like a pretty long contract. So like, the way we account for it, obviously is we just at that point you just have to look at the cash balance of the business, right? Like if this is a $50,000 invoice, and like sure, over time we'll get paid, but with the cash balance and like it's pretty nuanced the very first time you sell into a retailer distributor, but that's like actually was a pretty shocking thing to like for us and to just be careful about.
Yeah, because they can be shockingly low. Like you can actually get $0 paid.
It's not shocking low. I'd say that is like on the $50,000 PO for the first, for like a first time entering if you're a small brand. I would say like there's like a 50% chance you should actually expect $0 on that. It's not like the exception. It is probably the norm.
It's very common.
So
Jenna just said we see that. Yeah, I feel you on that. Awesome. Other questions that you have about invoicing or financing for your business? I guess one thing, Tej, like does financing get easier or cheaper the more you work with a retailer? Like does that decrease the risk or
listen, what we do, let me put it this way. Like the minute we get cash back from a big retail, like, so we'll factor someone's, just now we factor someone's Sprouts invoices, right? The biggest risk for us is like, hey, like you send the NOA and like the retailer, they accidentally pays back to Sprout, like the brand, instead of Sprouts paying us directly, right? We've seen this happen, not for Sprouts, but other times. And it's like, you're quite like, you will do it. It's like, it's risky. The minute we get paid back directly from retail, it opens up like infinite, like ultimate, like approvals are like this. It's like, so it's kind of it's in my opinion, like, well, first of all, I guess it's an obvious, the first part, but the second part is like, even from an invoice factoring perspective, if your invoice factor has gotten paid back first by at least one transaction, to at least know that the rails work, right? Like that the bank details haven't changed over, etc. But you're right, which is sometimes for invoice factoring, the advance rate will give if it's the first time. So we once gave a term sheet to a brand. They're a pet brand, and they sold into a national retailer. And the way they had it's the first this is like one of the top 5 retailers in the world in the US, and it's a really high quality product. And by the way, this is the other thing, like normally for small distributors, they send you invoices, POs all through email, right? And so it's like easy, whatever. The minute you sell to any national, like a Target, Costco, et cetera, it's through EDI, which is basically it's kind of like it's like a portal. And what EDI basically says is that, long story short, if you mess it up, there's a chance Target or Walmart just doesn't pay you for 3 months because like, hey, the format in which you sent your invoice was like wrong and our servers did not accept it, et cetera. And so there's like these operational things which are like extra cautious about, right? When the first time you're selling into a retailer, if you're a brand that does 5-10 million in revenue and you're entering a retailer the first time, we'll factor the invoice. But like that is another thing with sometimes invoice factoring companies or PO financing will not finance the very first transaction for a specific retailer. Is what some others do. Yeah.
Yeah, I think that's actually good because I think a lot of people are waiting until they have an invoice that feels like completely out of hand in order to like go and get their first time PO or factoring. But one thing I actually recommend is if you have $50,000 invoice or PO to actually go through the process now when it's easy, when you kind of have the cash balance so that you can see how it works, make sure, like you said, like all the logistics work and you can have that experience so that your first time going through the process is not this like life or death, like monumental thing that's going to make or break your company. So you can like make sure all these things work before it's even risky for you.
The other thing with us is like, let's say, someone they sell to 3 different stores, Target, Walmart, and Costco. We are factoring someone's Costco invoices already. We are a lot more likely to do, and like for us, by the way, because we use AI, so we almost approve everybody. Like it depends on the advance rate, but we'll almost approve everyone as long as we're getting paid back to retailer. But like for us, if it comes out to advance rate, do we like 100%, 80%, et cetera, et cetera. And so if we are already factoring someone's, for example, Costco invoices, we are a lot more likely to do their, Target and, Walmart at a much higher advance rate, or, most invoice companies that they'll even likely do it. Why? Because let's say you under $50,000 PO, if your, hot sauce just breaks and you can't deliver it, the invoice factoring companies will just make the money back on the next Costco. Like as long as you can like for us, it's not really about the interest. Like interest matters and the rates we charge, but the last thing we want is, for example, a $100,000 transaction. If we lose the 1,000, maybe we have to waive that. It's not the end of the world. It's losing the entire 100,000, right? And that often happens, whatever. So in that case, if you have 3 retailers, they've already done one with invoice factoring company. They know that if the second or third, like sure, if it doesn't work out, they can get their money back by just continuing, over time to, not pay it out additional on that the existing retailer they have, but still collect cash from it. And so like from a risk perspective, if there's an existing client and they've had money processed through us, that's at least how we view it. And I'd suppose that, that's this, from a risk perspective, others view it the same way as well.
Awesome. Tej, this has all been super helpful. And Will, thanks so much for sharing this, and thanks for everyone for your questions. Tej, like you mentioned, I think like brands should reach out to multiple different companies and see what they offer and the terms. But I know SpringCash has a really attractive offer for new customers right now. Would love for you to share that to our
Yeah,
audience.
the first invoice. So ours, what we've done is we've turned, a 2-month process with normal invoice factoring, diligence into like truly hop on a call with us, or you can do it on yourself, drag in an invoice. So the one thing is that like our rates are like ultra low because my co-founder Samir owns a bank, et cetera. The one requirement we have, you have to be in a retailer or distributor, like of, and you have to have an invoice. You've already delivered it for like for brands above a certain revenue. I mean, some of our clients are, 40, 50 million revenue, like no exception apply, every exception goes. But if I'm talking about for, in this category, it seems like a lot of the brands are pretty early on, that if you have an invoice and you've already delivered the product, then you can just go to springcash.com, enter, there's a work email option at the top, go through the process, and then you get approved on the spot. And so the first invoice, up to $50,000, there's no fees. It's, 0% APR. And so, yeah, happy to, also if it's, helpful, you can email me at tej, at springcash.com, or you can just text me at 609-917-8910, and I'll route it to the right person on our team that can, like is your point person on the account manager.
Yeah, so I love that. So it's the question earlier, like when should I start using it? Like if you have a PO or invoice from a distributor or a larger retailer, like get it done now, go through the factoring process, go through so you can get that at 0% APR, right? You just get the money up front instead of having it later. So you can go through and make sure it works, see how it works for your business. You can use it to plan for future financing. Tej, Will, thanks so much for being on again. Thanks so much for everyone listening. As I mentioned, we will be sharing out the recording. So if you missed anything or want to share it with your team members, you'll be able to do that. All right, everyone. Thanks so much. Have a great Wednesday.
Nice to meet y'all.